This is obviously the last day of the Middle East week, Thursday, December 9th. Not for much longer will Thursday be the last day of the Middle East, or certainly the UAE week, because we are going to be moving to a Monday to Friday week here in the UAE with the change of the laws announced this week. But meanwhile, Brent crude oil continues its march upwards. We're seeing it firmly this morning above $76 a barrel after another climb yesterday. And the market is opening up again in Asia this morning. So clearly, bullish tendencies are back. Let's welcome Mike McGlone, Senior Commodity Strategist, Bloomberg Intelligence, for our bear analysis. A tough day to be a bear, it would seem, since OPEC announced last week. Mike, how do you read the market at this stage?
Yes, Sean, I like to ignore the noise of the daily markets. And I see what we've done is probably put it in a longer term peak, just above 85. And I think it was in WTI, it's about 87 in Brent. And I think we're going back to that longer term trajectory, which was really since 2008, 2014. And I see nothing. I see macroeconomic, fundamental, technicals all bad for crude oil. So I still fully expect WTI to head towards 50. That's basically the average price of the last 5 years. It's still well above the U.S. cost of production. I see U.S. Converting to a net liquid fuel exporter next year. That's not profound. That kicked in 2019. It's going back there. The Fed's tightening. The Fed's going to be tightening, and they'll keep being hawkish until this market tells them not to. Most notably, the stock market. So I see nothing good for crude oil. And then, I'll end with this. You have to ask yourself, why is crude oil half the price of the peak? Copper has peaked. Soybeans have peaked. For markets to continue higher from here, we need a renewed shift in what's been pushing it lower for the last 10 years, a renewed bull market. And then I look over as a commodity guy, I see nothing but pretty strong elasticity of supply in all commodities, and demand not as elasticity of supply, demand too. But then I look over at things like Bitcoin and Ethereum, and I see no elasticity of supply. So that's where my bullish inklings are. I do think gold. I think gold will be one of the better commodities next year, and most metals and energy will revert back to the longer term trends, which is lower.
Carol Nachley, CEO of Crystal Energy. Carol, your thoughts on that macro outlook? We're coming to the end of the year. We obviously had a big wobble around Omicron. That seems to be in the rearview mirror now.
Good morning, Sean. Good morning, everyone. Not quite in the rear view because, of course, what we're seeing in oil markets today, the rebound in prices, Madonna call it rally, is part of an overall market rebound. So if you also look at what's happening in the rest of the markets, you can see things have recovered from the shock that they had when the Omicron variant was announced. Mind you, we are getting some positive noises and some positive statements about, for example, from Pfizer saying their booster works against the variant. But how many people remain unvaccinated, let alone to get the booster? Scientists say it's still too early to decide whether the variant is mild or is going to cause some serious infections among the vulnerables in particular. So we're still in this kind of uncertain period, but we are getting some positive signs, and that is having positive spillovers on markets, including crude oil. What is more interesting is that what was going to happen between now and the end of the year, the holiday spirit, markets shut down. It's mainly for next year. And next year, while the demand remains a very important factor in oil markets, I also see supply playing an equally important role. What will OPEC do? What are additional supplies we're expecting from outside OPEC, particularly from shale? Will the SPR release be maintained? These are questions that will be interesting to look at for next year.
We saw, Carol, the report overnight in the digest that OPEC Plus did make up its 400,000 barrels last month. According to secondary sources, it was up to 500,000 plus additional supply in November. So OPEC are starting to catch up a little bit on those deliveries. Your thoughts on their decision last week to move ahead with the increase into the new year?
Traditionally, if you look at OPEC, let's say, call it OPEC for a longer history, when they kind of did not, kind of have an aggressive position vis-a-vis the market, it's either because demand is collapsing and it is usually too late to catch up with that, because you realize it when it's too late, because the data, there is a lag between the data arriving and us realizing it. And the other factor is political pressure. And the political pressure, particularly from the US, has been mounting over the last few months, gently asking OPEC, I would say, to release more barrels in the market. And we see this kind of decision by OPEC. I would say it was primarily a political decision rather than a market decision, especially with the kind of increase in prices that we saw. So it did not come as a surprise. And again, the increase in OPEC production.
Sorry, what was the political part of the decision when you say it was political?
That, the OPEC does not want to confront US. They wanted to follow on US. I don't want to say orders because it's not orders, it was a request. So they wanted to maintain this kind of positive relationship or good relationship with the US rather than being seen as a confrontational position. And mind you, the US did not announce the release of the SPR in an aggressive way. They kind of prepared the market and OPEC for this kind of release, and it's happening hopefully as of January. So that's why I say it's a political decision. And the increase in OPEC plus, I know for the last few months, people have been concerned about some countries in OPEC not able to deliver on their production quotas. But all along, OPEC plus has been about Saudi Arabia and of course Russia. But it is OPEC and Saudi Arabia that matters the most for OPEC, and most of the increase came from Saudi Arabia.
James McCallum, Executive Chairman of Exergy and Energy Professor at Strathclyde University, a long way from Strathclyde at the moment. James, your thoughts sitting there, I believe you're in Sharjah. I'm sitting here in Abu Dhabi, just had a meeting with ADNOC, about to meet with the Ministry of Energy. It feels on the ground here like it's full steam ahead, add as much capacity as you can.
I think that's probably right, Sean. I mean, there's been quite a bit of manoeuvring in the marketplace in the course of the last week, as we know, on a geopolitical stage, and I'm sure you'll touch on that later in the call, with people moving around the region, establishing what I see, if you like, is the sort of like the scene for next year. There now seems to be a widespread view that would support the position that Mike is taking there, that we may have seen sort of really the top end of the sort of like the price range as we come into the end of the year, and many people see the oil price markets softening. I thought it was a shrewd move of OPEC to just follow the pattern that they had declared, but I would draw the listeners' attention to.
Would you say brave, shrewd, or
no? I think shrewd. I think Clyde Russell earlier in the week on one of your podcasts made a very, very good point. We need to make sure that we are always looking beyond just the words to what's actually happening on the ground. And as we all know, and you just referenced it a second ago, we should be at around about 1.6 million barrels of increased production by now, and we're probably at about 1.1, 1.2. And by the time we get to the end of December, that number should be 2. So clearly there is a shortfall against where production should be. At the moment, I think it's right to stay the course. It's right not to rattle the cage, if you like, of the economies of the United States and India by taking an action which would seem to reinforce a desire to have high prices in the marketplace. So I think I think we'll just see more of the same through the course of the next month, and I think we'll then see material change in January.
Mike, there's continues to be very positive macro data out of the US. We had report overnight that there's 11 million jobs currently advertised in the US economy that need to be filled. We've got JP Morgan projecting that 2022 will see a full global economic recovery. It's all steam ahead here. I mean, would you not see the bullish case?
All steam ahead means higher rates from the Fed, which means a stronger dollar, which means potentially a peak in the stock market, and everything's connected. So the significance of the macro is, yes, that is, those are known knowns. It doesn't necessarily mean more demand for petroleum from this country. In fact, we're in decline. 20 million barrels a day of liquid fuel is the same as it was in 2005, and we're starting to go down. for efficiency reasons. And people like me, we don't have to commute. Everybody's locking back down again. So I look at the macro as nothing good. And then you look over at China. China's moving in. They just cut their RRR rate. There's nothing good in the macro, I think, from what's happening, except what you pointed out. And remember, what we have is the highest correlations of stock market ever. We have a renewed impetus from the Fed to be hawkish. They said they're going to do it, and they're going to continue to do it until the stock market tells them not to.
What does hawkish look like from the Fed? Do you think we're talking about tapering? Because originally it was envisaged that the tapering would be within 6 months, the bond buying program. Do you expect that to be cut in half, or what would you think would be the time frame?
Taper is a baby step. Right now, Fed fund futures are priced for 100 basis points of hiking next year. That, to me, is a dream. It's very unlikely. It's basically 4 hikes by the end of next year. And that's pretty aggressive. But I look at it as the only one key factor to stop that from happening. That's the stock market going down. So last time the Fed was on zero, they were there for 7 years. I fully expect they will be. So I think we're going to get, the biggest issue is reversion, and the Fed's going to stay hawkish until the market tells them not to. So right now we have 100 basis points of hiking priced in. What does it take to take that out? And it stays in until the market, and then you have issues with the stock market. It's like the most expensive in history. So to me, it's the macro, it's the big picture. And Fed is pointed out, they said inflation is no longer transitory. So we've got a renewed Powell, and the Fed worried about inflation. That's nothing good there. And if you're right now, if you're long risk assets, you're fighting the Fed.
Carol, we said earlier, Omicron is not quite in the rearview mirror. We saw overnight in the UK, besides Boris Johnson having yet another sort of own goal, as they say in football, but nonetheless, he's introduced some fairly stricter protocols around COVID, encouraging work from home. Germany is seeing its numbers soar, schools closing in Denmark, etc. It does feel like the second, whatever wave it is of COVID in Europe is going to continue to be an issue and somewhat of a downward pressure on economic growth.
Sean was someone who was having first-hand experience on what's going on in Europe, or at least here in London. I can tell you there is a big gap between what is being announced and the kind of severity of the measures that are being presented and what is happening on the ground. You go to shops, they do have notes that say it is by law mandatory to wear masks, and none of the staff in that shop is wearing a mask, even though standing exactly in front of those notes. Who is implementing them? Who is enforcing those? No one. You go on the bus, you have, they say also it's mandatory to wear it on public transport. People get in. What can the bus driver do? Nothing. They just press a button and says that you have to wear a mask, but they cannot stop them from taking a ride. So there is a difference, some kind of disconnect between what is being announced that gives the impression that tighter rules are going to be implemented, that will reduce mobility, that can have negative spillovers on the economy. But on the ground, people are fed up, especially, for example, here in the UK, if you heard about the scandal about a party that the government organized, or at least some people in the government, at the height of the lockdown last year. So so the announcement of these new measures coincided with the announcement of that, or the when that scandal has been revealed. So I would be careful in terms of not comparing whatever measures that are introduced today with whatever happened last year, because the impact would be much milder.
The politics of that, if the government is losing credibility to enforce protocols, is that something that one, from a macro point of view, should be concerned about? I mean, there's consequences of non-conforming, infection rates soar, etc.
I think what many people are saying when you talk to them about the infection rate, they say it's the death rate that matters more. And it seems that while the infection rates are going high, it's not being accompanied by a higher death rate. And therefore they say we have to live with it. We're moving from a pandemic to epidemic, and that's what is a normal process. What the political cost can be, actually, if you look here at the UK at the popularity of Boris Johnson, it is really at bottom low. He is among the least popular popular politicians, at least in the Conservative Party. So that would carry more a political cost than I would say an economic cost, again, because these lockdown measures are not having major implications. Of course, if the variant goes out of control and causes massive disruptions all around the world, that's a different story. But still, irrespective of Omicron variant, there are, and here I agree with Mike's view that the economy is not, rebounding strongly and everything is happy, is good, and we are all going to live happily ever after. There are still scars from last year's policies, from the economic, from the pandemic, the crisis like no other, that will stay with us for years to come. And here I want to draw your attention, Sean, to some noises coming already from the US. If you heard what was reported yesterday in the media about US politicians blaming oil companies for not putting more oil and making more profits, that is for me an indicator that higher taxes are coming down the road, and quite soon.
Well, that's a good segue to James, because James, I wanted to ask, obviously, probably the last time we'll have you on the show this year, as we're going to wrap up in a week's time for the holidays. But your thoughts on where the majors are. I thought it was quite interesting. We're only a few weeks since COP26, when the sort of upstream oil industry took quite a battering on the narrative and on the policy side. But yet, the last few days in Houston, we've got a fairly robust IOC and NOC CEOs sort of taking the task to the government and policy making, and sort of being quite confident and bullish. Your thoughts on where the industry ends the year?
Well, I think it's, and on that basis, perhaps only more appropriate would be to sitting on the control deck of a drill rig. Here I am on the wheelhouse of a very advanced diving support vessel, the DSV Picasso for ultra deep solutions, which is about to go out and go on to operations. There is clearly a move with the oil and gas companies to get back to an activity set where they can. Now, that's quite interesting, Sean, because certainly what I'm beginning to see on the ground is that the group that's getting ready to mobilize is what perhaps once would have been called the second tier operators, just below the super majors. Clearly, you touched on the national oil company position, which is really built around what Saudi and Abu Dhabi does, and then there's also the other members of OPEC. But that's the heart, if you like, of the national oil company scene. The one thing which is I'm going to follow with interest through 2022 is, the relationship which the super majors actually have with oil production levels. Now, historically, they would have had a direct relationship. Their name would have been above the door. They would have had their labels on the front of this diving support vessel or around the top of the derrick on a drill rig. What I think we are seeing the beginnings of is that the super majors will be continuing to move on their energy diversification strategy, but it will not be wholesale at the cost of their commitment to hydrocarbons. They will begin to enter into more partnered relationships where others are actually have their name above the door, not Shell, not BP, but they will continue to have involvement. So that's what I think is going to happen.
James, obviously through this cycle, your former space, the oil services space, the supply chain, if you like, took a very big hit on the downturn. I remember a year or so ago, ADNOC announced like overnight they wanted a 30% cut on every cost contract they had. How has that now filtered through to the supply chain on the recovery side?
I think it's way too early to be hailing a recovery in the service sector. The OSX index is still, at about 25% of the position that it would have been prior to 2014. So the service companies are hurting, and they're still hurting badly. Ask any major contractor what it's like to get paid for the jobs that they actually deliver, and they'll tell you it takes a very long time, and often, you end up in the law courts. So we're a very broken industry still, Sean, very, very broken. I think, clearly, on a personal note, I'm investing in building the digital solutions that will help companies become the best version of themselves that they can be with our Proteus products. And that's where I think we will all emerge. We will live in a world of the low-cost producer. We will live in a world of the low-margin supply chain company, and we will live in a world where staying connected to talent, which we switch on, switch off in an increased digitized world, will be the norm. And the winners will be the companies that can actually make that work for them. And if you're taking another point in terms of what came out of COP26, you referenced that earlier on, we are now firmly into a world where TCFD, or Task Force for Climate Financial Disclosures, will be a key part of every single project, every single company's operations. And if you can't show excellence in that area, you simply won't gain access to capital to do your projects or to take forward any of your business ambitions or strategy.
Let's go to the survey question, which looks at this recovery we've seen in the oil price over the last week since the OPEC decision, and since really, I suppose, Omicron started to at least appear not to be the worst case scenario. Some Pfizer CEOs saying it's okay, we can tackle it. It at least up till now looks like we're not going to get this sort of Armageddon version of Omicron that was predicted 2 weeks ago. So my question today is, Brent will move back above $80 before the end of the year, which of course is only in 2 or 3 weeks time. So this recovery, we're up about $7 since the low. And so will we see this momentum continue through $80 before the end of the year, which is, as we say, only, 10 trading days away? Carol, your thoughts on that momentum in the recovery side? We obviously dropped low for, would appear, very specific reasons, i.e. Omicron was the trigger. Mike is articulating that it's more cyclical, downward nature. But from your point of view, we've been in the 80s for quite a period before Omicron. Will we recover there, do you think?
Everything is possible. It's like the weather. And, those people who were predicting 90, 100, or even 150 by the end of the year kind of postponed their expectations now for next year. With oil markets, I always say that we are more able to, more accurate in our weather conditions than we are with oil prices. So everything is possible by the end of the year. But really, the question that we should be asking is, if we go back to these 80 levels, 80 or 85, or even above 85,
well, the
are they
high
going to be
was
to sustain for
Brent
next year? Exactly, because I think in October, I'm not quite sure when in October, and then it dropped. But again, we have to look at oil prices. If you're taking an investment decision, a yearly figure, and also long-term trends, not just this kind of short-term volatility. So I'm not quite sure I will learn much from this kind of, sentiment-driven changes in prices, which don't really give us a good indication of what's going to happen, what is a longer-term trend in markets. And as I said earlier, I think next year with dynamics are much more exciting than what we are seeing today.
It does indicate, I was just going to say, it does indicate, the idea of the stability in the high 70 into 80, but the idea that demand is robust, right? We saw inventories decline this week. They've been on a somewhat declining trend line all year, well below 5-year averages. A very confident move by OPEC last week. You say it's political, I take your point, but ultimately a decision that, the fear of a weaker demand didn't, at least as of yet, hasn't materialized. Demand would appear to be still robust.
The demand is still there, Sean, but again, data takes time to come in, and it's difficult to decide on the demand only by looking at 1 week or 2 weeks changes. And mind you, if I want to take the bigger picture, and I know I'm always escaping from answering this kind of what's going to happen tomorrow at 4 p.m. But again, there's a bigger picture to keep in mind that historically, after every major crisis, oil demand in terms of growth, not in terms of volumes, it kind of was growing at a slower rate than, let's say, pre-crisis. And this is what we should keep in mind if we want to have a learned judgment about where oil markets are going.
Mike, just to wrap up your thoughts, I mean, it's a big political week for Joe Biden, this face-off with Russia over the Ukraine, moving into obviously an election year, Iran talks in Vienna. What sort of wiggle room does the Biden administration have, do you think, on these big geopolitical conversations? And what are the relevance for the markets, depending which way they go?
I look at them as from a market standpoint. I have to answer it from the backward end. It's more noise. Some kind of silly war would not obviously be good. It's hard to predict. You have to look at the macro big picture. One thing we need to bring in this conversation is the U.S. price of natural gas has dropped back to the same price as 1996, and it's still double the cost of production. And what's been the major pressure on petroleum prices for the last 10 years? U.S. massive production of petroleum and hydrocarbons. And that's accelerating because of higher prices. It's up to the Biden administration not to mess it up. And yeah, they've cut back a little bit, but it really accelerated during the Obama administration. So this is the problem for the world to look at. The U.S. is a net massive exporter of energy, and it's increasing. Doesn't need OPEC anymore, and that's what that's what's happening. That's what happened with the latest SPR release.
And your thoughts, Mike, on the comments coming out of whoops, did I lose my
We can still hear you.
Oh, you're good. I was just saying the situation of the commentary out of Houston at the conference there the last few days, fairly boisterous, confidence sounding oil CEOs giving out to the Biden administration for rushing the transition. Your thoughts on their commentary, and will it have resonance in the U.S. body politic, so to speak?
Not so much. The bottom line I look at from oil CEOs and oil companies is massive profits, which means more supply. And yes, those are the publicly traded majors. There's hundreds of independent little oil companies. I used to be a farm owner. I just cannot wait to bring on more supply, and that's all my data shows.
Okay, let's get the survey result to give James the last word. Sitting on the vessel in the Persian Gulf, agree Brent will move above $30 to $80 a barrel. 70% in this room at least in agreement with that. So bullish outlook here, James. So hopefully that vessel will have the budgets to go to work. Did we lose James on his vessel in the Persian Gulf? Maybe we did. James trying one, trying twice. Not there. Okay, he's gone. Maybe he went diving. Listen, we'll wrap it up there for the week.
No, I'm back with you.
You're back.
Back
there
with
you
you,
go.
Sean.
Okay.
If,
I was just going to give you the last word
look,
on a bullish room.
Well, thank you.
Breaking through $80. Hopefully that'll trickle down to the supply chain.
So I think we come to the end of a week where, to be honest, at the end of the year, I think we've seen some great touch points for going into next year. We're at a week where perhaps if you'd had Omar and Mike on the same podcast, God forbid would have been in agreement in terms of oil prices they come out of this week.
They are the only two
clearly,
people.
I think that's really interesting. Yeah.
They're the only two people that we haven't put on the same show all year, because I'm not sure the fireworks how that would transpire. But anyway, it would be great to get them on together.
I look forward. Yeah. I think I look forward to that. Look, the truth of the matter is the energy markets crave stability. They crave stability in price. They crave stability in taxation, because with stability, you can make sound investment decisions. Mike and I, clearly have an occasional disagreement around, what will or won't happen in the Permian Basin. But the reality is we are entering a world, particularly referenced in in the press digest, where Goldman Sachs say we're returning to an economic boom year in 2022. Maybe that's right, maybe it's wrong, but there will be continued demand for the product of oil. There will be continued ability for people to produce that oil. We will see a continued move through 2022 towards diversification and digitization. And I think, watching the movements of the political leaders here in the Middle East, I think we are beginning to see the real footpath being laid for Iran to come back steadily into the OPEC equation and back into stable Middle East politics. I certainly hope so. I think I look forward with a fair degree of optimism. Obviously, Omicron heading into the background as we move into the early part of the year, I certainly hope so. But I see a strong year for 2022, and I'm really excited about it. I wish everybody happy new year and a very happy holidays. And I look forward to seeing you next year.
Well, it certainly has been an interesting week in the Gulf in that respect. We've had the Saudi Crown Prince on a tour through the region. We've had a senior intelligence minister from UAE in Tehran. We've had the Turkish president in Qatar, where a lot of the regional rapprochement seeds are being planted, inshallah, as they say, that could harvest in the new year to being a more stable region in which, I mean, you imagine if Iran opened up to the economics of the region and Turkey as well, both countries with close to 100 million people, Egypt as well. You know, there's some very big local regional markets. If we had stability, there would be really a very positive outcome. But that's a whole different narrative. James, thank you so much. Really great to have you on the show this year. Welcome you back in January. Mike, of course, as always, great to have your insights. Carol, I think we're going to have you one more time the next week, as you are the permanent weekly feature, and we're very grateful for that. See you all. Have a great weekend. All the best.
Bye-bye. Thank you.
Thank you. Thank you, Sean. Thank you, everybody.